Hey everybody, this is Ryan Mallory with SharePlanner.com, swing trade in the stock market. In today's episode, it's going to be a good one. We're going to be talking about luck and skill and how the two really intertwine with each other and they play off of each other. And this email here comes from a guy. He's excited about the redneck name that I'm going to give him. And for those who don't know the reasoning behind me giving redneck names to all the writers to this podcast show, it's because I don't want to use their real identity, so I give them a good Florida redneck name because I'm from Florida. I live out in the boonies. I'm pretty much a redneck myself. So it's a way for you guys to be able to relate to me and me relate to the audience, I guess. So in any case, for this episode, I'm going to call this guy the Yoinker. And the reason why is there's this guy, it's actually pretty impressive. He lives down in the Everglades, or at least he visits it quite a bit. And he's on Instagram. You can see him on there. And he goes up to these animals like anacondas and eels and crocodiles. Yes, we have crocodiles in Florida, believe it or not. Alligators, just diamondback rattlesnakes. He taps the top of their head. He calls it, give him a good yoink. And so we're going to call this guy the Yoinker in honor of this guy named, I think his name's Garrett. He's on Instagram. It's quite fascinating, but he's like the epitome of Florida man. In any case, Yoinker writes, "Hi Ryan, my name is whatever you decide to come up with. I can't wait to see what you come up with." Well, we came up with Yoinker. And I recently found your podcast and have become enthralled. I used to be heavily invested in the financial markets, but lives, I've never heard that expression before, lives, and I got away from it in the past few years. I've recently started getting back into investing and trading and have used your podcast as a helpful way to renew my interest. To give a little background on my personal history in the markets, during college, I was head of our Fed Challenge team and student government president of finance and graduated with a BS majoring in finance with a minor in economics. I spent 5 years on the street as a licensed sell-side trader and earned my level 2 of my CFA. I spent years studying in the Ben Graham style investing and have always considered myself to be more passive, deep value investor. But currently market prices are too high for me as a deep value investor, and I've had interest in getting into swing trading. All that is to say, I have a decent handle on managing risk and portfolio size, and I know how to use different order types to protect myself, like stops, limits, etc. But even when I was a trader, I never heavily studied technical analysis. In this renewed market interest, I've been practicing trading technicals, mainly studying support and resistance lines and trend lines, and I really like the wedge breakouts, and trying to study volume as well. In turn, I have a few questions if you could help. I know it's hard to explain charts in a podcast, so I've included as much detail as I can to help paint the picture. First example, I recently took a trade and I'm still trying to figure out if I got it right or if I just got lucky. ASAN had a long-term, that's the stock symbol, had a long-term support line around the $13 level, bouncing off of it in March, April, and June. In early August, it bounced again, and I entered the trade on 8/14 at $13.71 when I felt support was validated. I set my stop at $13 and my target at $15.25, a level that showed previous resistance at 2 to 1 reward to risk. I was able to take profits along the way, selling 20% at $14.55, 30% at $14.75, and finally selling the balance, which was the final 50%, at $15.52 when it ripped overnight on 9/4. Thank you for your 30-minute rule, by the way. No new positions, just lots of profits. The trade definitely worked, but I'd love your opinion if I made a good call or if I just got lucky on the trade. JBHT, this is the second example, has had a lot of price activity lately around the 145 level beginning in August, and it has ripped above but always comes back down, and over the last week have been unable to break out. I've been watching and, more importantly, trying to read the volume. There has been more buyers, but recently the volume has been declining. The buying was also seemed to be higher below 145 than at or above. I'm trying to figure out if there is a big buyer sitting at 145 top, and when they clear out this stock, when they clear this level out, will the stock tank? Or the opposite, there's a big seller with a 145 low, and when they clear this out, the stock will rip. Alternatively, is this a total whack job way to read volume? And if so, can you point me in the direction of how you would like to read it as a technical trader. Thank you for all you do. Your podcasts are great and have really helped me get back into the game. Sincerely, the Yoinker. Okay. Overall, I do like the questions here. I think that there's a lot to dive into. What's kind of interesting is both me and Yoinker here, he and I both started off trying to succeed at investing and then eventually got into the swing trading. Now, for me, when I started in 91, my dad was getting me into the stock market. I was starting off with like $5,000 that I inherited from the lady that raised my mom. And you can go on my website and I talk about that a little bit more, but essentially I was doing some value investing, doing mutual funds and so forth. And then when I graduated college, I started doing more of that. I was investing in some value plays, and believe me, in 2003 or whatever it was, Walmart was not a growth play like it has behaved of late. It was a very slow moving stock. But anyways, I was getting into some of those kinds of plays there, and they were very boring, honestly. Like if I could make like 4 or 5% in a year on those things, it was almost like trading bonds. But I started getting into swing trading because I wanted a little bit more movement, a little bit more volatility, and in this case, like with this podcast listener here, he's in a situation not so much where he was looking for better returns, but because the market has become so overvalued, there's really not a place at the moment for a deep value investor because there's nothing that really sells at a really good value right now. I mean, you look at the PEs of Walmart and you look at how overbought everything has become. It's really hard to find anything that you can invest in. In fact, using some of the technical analysis tools that I use, like the T2108 and so forth, to help myself time my long-term investments, you hardly ever get a reading below the necessary readings that would justify getting into a long position. So I get where Yoinker is coming from and not being able to find anything of quality investments when you have stocks that are trading at 600 PEs and they're worth, $500 billion. Yes, Palantir, I'm talking about you. Where in the world are you going to find something that offers a good long-term value? So right now, you don't have that until we see a significant pullback in the broader market. And we had one in April, but what did that last for? Like a solid, couple of weeks? I mean, it wasn't that long. It was from March to April, essentially. So we did not get, and it was early April at that. So we did not get a huge sell-off. From a percentage standpoint, we did, but we didn't get it to last for very long. So if you were trying to build a long-term position, you really didn't have much time at all to do that. You couldn't really build it over time. I was able to do that to a certain degree in 2022, but even then, it bottomed pretty quickly once October hit. Now, one of the things that I think as a trader that has helped me, and I think this is where somebody like the person who's writing the show here, Yoinker, he's going towards swing trading because one of the value to swing trading, and really one of the keys to success in swing trading, is that you can't really care about what the market's doing. You can't really care that it's ridiculously bullish or far too bearish, depending on what market you're trading in. Instead, you have to look at the market for what it is. Your personal opinions about the market can't matter. If you start to let your personal opinions interfere with the market, then you're going to likely make some bad trading decisions. Like for me, do I think the market's ridiculously overvalued? Yes. Do I think it's almost to the point of just sheer stupidity? Absolutely. But from a swing trading standpoint, I'm not looking at it from a fundamental standpoint that would judge it on those merits. I'm looking at it from a technical basis. So I can get into stocks and know that they're extremely overvalued, but my time frame and my outlook on those stocks are such that it doesn't really matter what my fundamental view of the market is. It matters what is the charts telling me and how am I reacting to what the market's doing right now. With us trading just a hair below all-time highs right now, if the market wanted to go up another 10% from a swing trading standpoint, shouldn't matter to me, because as a swing trader, I'm not trying to justify that from a fundamental standpoint that it's a good value to be getting in at these levels. What I'm doing is looking to capture some momentum that might be arising in a particular stock or an ETF and ride that momentum as long as that momentum will carry me higher. Another question that he has, so he talks about ASAN where he gets in. I loved how he planned out the trade too. And I liked seeing how somebody else does a different way of taking profits. For instance, he took some profits. The first batch, he took 20% off, and then he took another 30%. And then he rode the last 50%. Now, for me, I'm a little bit more basic. I'm like a third, and a third. Neither way is wrong. And that's what's kind of cool about it, is that he's found out what works for him from a trading standpoint, and he is implementing that into his trading. So for him, it's 20, 30, 50. For me, it's 33, 33, 33. I guess maybe that last one's like 34% to account for that, 33 and a third. But everybody's going to be different. Everybody's going to have a different risk preference. And that's what I think is so important here, that Yoinker is trading according to his tolerance of risk and what he's capable of handling. Now, he gets into ASAN after it started bouncing off at the 13 level, and then he gets in at 1371, rides it up to 1552, takes profits along the way of 20% and 30%, and so at 1552 he sells that last batch. Now, is he lucky or was he right? I don't think that it matters if he's lucky or not, because there's going to be a lot of luck in trading. There's going to be a lot of being lucky, and then there's going to be a lot of being unlucky. And I experience both on a regular basis, and really what it comes down to is how are we responding to that luck? How are we responding to when we're the times when we're unlucky? And are we still managing the risk? Are we taking advantage of profits? So you get into a stock at 100, for instance, and all of a sudden it gets upgraded and it's trading at 110. Are you lucky? Yeah, I guess you could say you're lucky because you weren't getting into the trade knowing that it was going to be upgraded the very next day. That's kind of a nice gift and something that should be celebrated. And I don't think it takes away from the success of the trade. You could say, well, looking back on that trade, I just got really lucky. No, it really comes down to how did you manage that luck? And if you manage the luck well, then great. You did the right thing there. You don't have anything to frown upon. So perfect example is just even today, I was in Spotify. So the market's trading off pretty significantly today. And I had gotten into Spotify a couple of days earlier, and I was up about 2%. And they had a little news piece that they were partnering up with somebody. And the stock goes a lot higher at the open. Now the market's selling off, but Spotify is going up, and so it's up like 3 or 4%. I use it that opportunity where it's trading higher, and don't even necessarily didn't expect it to trade higher. I thought with the market trading lower, it would probably weigh heavily on Spotify. Instead, it did the exact opposite. I used that opportunity to take profits off the table, so I took a third off the table, made 5%, and then the stock faded the rest of the day. I ended up closing out the trade for a smaller percentage on that final 2/3. But what I did right is I used my trading plan to be able to take advantage of that luck. So at the open, when it was soaring higher and I wasn't sure if it was necessarily going to be able to sustain that move, nonetheless, I used that opportunity and what you might say is getting lucky on that trade to take some of those profits off the table. So that's where the management and luck met, and really it was about how you manage that luck. Now, another thing you can do, and it has nothing to do with luck, is to check out the Self-Made Trader. If you want to be able to learn how to manage your trades and learn how to get into trades and learn everything it takes to go from the very beginning of trading, the basics of learning technical analysis, all the way through my more advanced strategies, you want to check out the Self-Made Trader. You can go to sharepointer.com, click on Trading Academy, and right there, you will see my course, The Self-Made Trader. Here, you're going to learn everything that I know about trading. I've spent about 4 years developing this course, and in it, I poured into it over 25 hours of instructional videos and exercises and lessons. It is something that will really be beneficial to anybody who wants to take trading serious. So I would highly encourage you to check out the Self-Made Trader at sharepointer.com. And in the process, you're supporting this podcast and everything that that this is about. So one other thing that I would say about luck as it pertains to trading is we talk about never doubling down. But a lot of times people, they get into a losing trade, they don't want to accept the loss. So what do? They double their position size so they can lower their average entry price or their average share price. And so what they hope to do is that they can get back into the green quicker, even though that they're deep in the red. I've always said that that's a bad idea. But in another way, though, sometimes we try to double our luck. We have a good news piece that comes out, the stock shoots up 20%, and we're like, oh no, I think it's going to go to 40% higher or 50% higher, or I'm not going to sell out of anything because what if this is just the beginning? Well, I don't want to take any profits off the table. And in the same way, that's kind of like, trying to double your luck, just like, you try to double your position size or you double down. What you don't want to do as well when you're up on a trade is to try to double the luck. You get something that's really good in a news piece you weren't expecting and it sends your stock shooting much higher. Take some profits off the table because you don't know how long that will last. So many times, really good news is failed to be seized upon or captured by traders because they wanted even more. They weren't satisfied with the good news that came out, the upgrade or the partnership that was created. They wanted more, and as a result, they end up finding themselves with far less because they didn't take advantage of those profits when they had them. Now, one of the things about this particular trade is that he went ahead and took profits arbitrarily at 15.52. He made a good trade there. I mean, he made a really nice profit. I probably would have done it a little bit differently. I would have wanted to say, okay, I'll take some more profits off the table at 15.52. I'd probably be down to a third of a position there, try to see how much further it can run from there. Now, on that particular stock, that means I probably would have taken a little bit more of a hit on the gains on that final third than where he probably got out with that final 50%. But nonetheless, I would encourage anybody, at some point when you're down to your last 0.25% of a trade or your last lot, to try to see how far you can let that ride and keep moving the stop loss higher, maybe even trim some additional micro profits off of there just to keep skimming it down some to where when it finally does pull back, you can go ahead and get out of the trade for maximum profit. So we don't want to try to double our luck. We don't want to try to differentiate between being right and just being lucky, because lucky, being unlucky, and managing your positions with skill and precision, they all go hand in hand together. He had another trade here, JBHT, that he was talking about some of the resistance at 145. Now, ultimately on JBHT, it kept hitting that 145 and pulling back, and then eventually, and probably because of earnings, it gapped well above it. So one of the things that I've noticed a lot of times with trading, especially probably over the last 3 or 4 years, is that when a resistance level keeps hitting and the stock is unable to break through it, it will use a gap higher, oftentimes as a result of news or an upgrade or just maybe some market momentum, that's strong market momentum that's heading into the close, to be able to push through that level in the pre-market. So then it opens up and it's already well beyond that level. I see that all the time, and they're able to do that because in the pre-market, typically your volume is far less than what you see during regular trading hours. So they can prop it up beyond that level and get past that resistance that he was dealing with on JBHT. Now, if you see a lot of volume at that particular price level, yes, that means that a lot of people are typically selling at that point. So until it can push through all those sell orders, it's not going to be able to break out. One of the great tools that you can use on that, depending on what kind of charting software that you use, is volume by price. Volume by price is a great way to see how much volume is at a particular price level, and something that a lot of people are starting to use now. I don't rely on it too heavily just because I'm pretty confident in my skills using the volume the way that I do, that sometimes I'll reference it, but I don't get too involved in it. But if you're starting off as a trader, highly recommend checking that out and seeing if that's something that works for your own trading benefit. So if you enjoyed this podcast episode, and I hope that you did, make sure to leave me a 5-star review on whatever platform you're listening to me on, or if it's on YouTube, make sure to like and subscribe to this channel and check out the Self-Made Trader. I would love for you guys to be able to check out that training course. I think it'll be very beneficial to you. And make sure to send me your questions, Ryan@shareplanner.com. I read them all. I try to make a podcast out of every single one of them. And want to hear your backstory. I want to hear your history and what's troubling you, what's giving you problems. I want to hear about that. So send me your questions. And remember this, Jesus Christ, he's the way, the truth, and the life. Nobody comes to the Father except through him. Thank you, and God bless.